Hello, everybody. Good morning. Good morning on this Saturday. I hope you have a great weekend starting from today. I know that many of you guys are busy during this weekend doing your own stuff, and really appreciate that you can come to attend this webinar live. And even you're viewing this recording, I mean, it's really, I want to express my appreciation for that. Why is this important? Because, many of my recommendations, when I do recommendation to you, I'll write in writing. However, sometimes it's very hard to explain everything in writing. It's easier to just talk about it or show you pictures, right? So, if you have attended the webinar or watch the recordings, you will definitely appreciate why certain things are done in a certain way. So very often I get the same questions being repeated, and many of these questions are actually not only repeated among clients, but it's repeated over time. Anyway, I will also address all these commonly asked questions in this talk, okay, so that so it's easier for you and me, and also serve as a reminder. So last 2 days ago, I had one client who responded to me 2 months after I made a recommendation. 2 months. So she thought that I don't know, maybe there's some misconception or whatever, but 2 months is a bit long. A lot of things have changed since then. So really, not in investment, there is nothing is static lah. We need to be always adapt to the situation and then act accordingly, right? And yeah, that's what I'm here for. I'm here to help you guys. Okay, just to be very sure that you can hear me. Forgot, can you please type 1 so that to acknowledge that you can hear me and that my IT here is working. Don't mind press someone just press type 1 so that okay, all the ones come out. Okay, thanks. Okay. It's okay. Okay, great. Okay, let's get started with the talk. Okay. Right, so today I'll cover the microeconomics and microeconomics, which is the individual investment. Okay, as per usual. Right. Okay, this is the disclaimer for this talk, and basically it's saying that if you need financial advice, please talk to me directly, right? Text me or talk to me directly, and I'll give you the individualized financial advice. So this talk is what I call a general advice. Okay. However, if you need individual advice, please approach me because your circumstances can be different. Okay, so here is the summary of what has been happening to the stock market. So the one month performance. You look at 1 month performance. China is 20% up, right? So we can officially declare that the China market is now under a bull run. So normally, wherever a particular stock index is, change from a bear market to a 20% uptrend, uptake, we usually most people will conclude it's a bull run. So China now is in a bull run already. And if you have took my recommendation 2 months ago, you would have seen a near double-digit return in your Chinese investment. 2 months ago, it was definitely not a bull run. It's not a 20% up. It was not. In fact, the year to date is 20%. So 2 months ago, it was not 20%. It was not officially a bull run. I remember when I spoke to you that I'm bullish on Chinese market. 9 out of 10 of you guys actually, after the talk, right, wrote to me, say that I'm talking nonsense, and you say that, no, it's not going to happen, it's fake news, it's misinformation, I'm never going to believe in this. You see, investment is not a religion. It's not something that you believe or I believe. It's nothing to do with religion. So don't get mixed up. It's just like some of you guys says that I don't believe in insurance. So now you say I don't believe in China, in this stock market, that stock market. It's not religion, right? So don't get it mixed up. When we invest, the objective is to make money. That is the sole purpose. Yeah, there's no other purpose. So don't go and be religious about it. So congratulations if you have followed my advice. And I'll explain to you why I had such a strong conviction that the Chinese market 2 months ago it's going to be a bull run. But of course now it's a bull run. Everyone is jumping into China's market now. Everyone. The other day I spoke to someone working in First Sentier, and she focused on Asia market, and she said that things have got better because the Chinese market now is now in a bull run. Her institution customers has become quite interested to invest in. We need to talk about Chinese market, and I was telling her that that's how investor works, right? When things are bad, they don't invest. When things are good, they invest. That's why everyone buy high, sell low, right? So if you have listened to my advice, you have bought low. But if you now jump into the bandwagon, now you are buying high, right? So if you want to engage my service, please listen to me, right? And I will be different from the rest. I will be a contrarian. Now, for other markets, it's also not bad for the, they say for the 1 month return for S&P 5% is very good, okay? And the year to date for S&P 500 is 11%. Not as great as Chinese market, but not bad as well. Okay, the S&P 500 or the US market now has reached the all-time high in all the 3 main indexes, namely the NASDAQ, the Dow, and the S&P 500. So they have reached the all-time high. Now, I'm not sure many of you are concerned whether this what I call bull run, does it going to be like is it going to be like force, something that's forced? Is it going to come down? So we look at history that it's true that when you reach all-time high, there are situations where the markets are unwilling to go above the all-time high. So you can see that the 2000 or in all these places, it just come down. There's no conviction. And then there are other times where there is a conviction where it broke the all-time high. Okay, and there's another conviction here in 2020 mainly after the COVID, and there's another conviction here. So really, it depends on whether the market has a conviction to see whether it's the all-time high resistance level where it's going to drop or it's going to come down. Anyway, because of the bullish sentiment, some bear analysts have become bullish. They have changed their mind. So the question is that, so is there going to be a correction? And definitely there's going to be a correction. That is really for sure. So why is because of the, you look at this chart here, which is the blue color is the liquidity of the market versus the S&P 500, which is the red color. And you can look at the liquidity versus the S&P 500. They are closely correlated. And wherever the liquidity goes up, the S&P goes up, and vice versa. So now, right now, there's some slight divergence where the liquidity is flat or coming down because of the monetary tightening, yet S&P 500 is going up. So based on this, correction is in a cut. Yes, it looks like it is. If you look at the technical analysis, if we draw a line, a support line, which is just a tree. Support line basically can be formed just by looking at the three lowest point, which here, and here. Then you see that the S&P 500, which is 5,003. Just now I just saw on Bloomberg, it's 5,003. The correction is imminent. So what is then the question is it going to be a minor or major correction? So around 14 to 20% type is 14 plus kind of downtrend is considered minor, as you see in this chart here. And then the moderate will be like 27 for 58. The severe type will be 50%, like global 40 or 50%, which is like global financial crisis. So for it to come down to support line is 15, so it's considered as moderate. I would expect that if it comes down by 15% to 4,005, that will consider to be healthy. So as long as it stays in like 4,003 and continuously goes up, is something is very uncomfortable, right? So I hope that it will come down to 4,005, and then we can just pick some good stocks again. Okay. Now the many people say that there's a lot of printing of money and so on, and they always point to the US, but really China right now is really printing a lot of money. So especially the Chinese, because the Chinese market has done poorly for economy, it's been done poorly for some time. Is right now at because of various crises, and one of them is property, right, has dragged down the economy. So Chinese has poured millions into the property market, a lot of qualitative easing. So the printing of money is happening in China, and it's not just the US, it's the Chinese market. So if you talk about the Chinese market, the Chinese investment year to date, you can see from this chart, many of the unit trusts are up by double digit. Okay, so everything is up. So the question is that question is this, is this going to be sustainable? Because right now there's a lot of good news in Chinese market. You look at you go on Google, CNA, very bullish, Bullish Times very, very bullish, CDY is bullish. So the question is that, is this just a false hope? Now, given that everyone is so bullish, even Goldman Sachs is bullish. Previously, they were not so bullish. Now, if we go to dissect, we try to do some surgery. Chinese market is very unique. They have many different types of share class, depending on where is it listed. Later, I'll give you a more, on this talk, I'll give you a more thorough explanation of all this, what is A share, H share, N share, all this confusing share. But bear with me. A share is basically companies that's listed in Shenzhen or Shanghai, and H shares are companies that's Chinese companies that are listed in Hong Kong. So if you look at the recent time, let's say from the beginning of the year to now, you'll find that H shares has been doing much better than A shares. But if you to extend the range to, let's say 2015, 2016, then you'll find that the H shares actually has been doing poorly, very poorly compared to A shares. And there are a few theories. One theory possibly could be H shares available to foreigners. So foreigners, they tend to move in and out of the market easily. Whereas for A shares are mainly bought by Chinese, and even if they sell the A share, they don't know where to park their money, because basically the money is all, due to capital control, it's all stuck in China. So H shares has been trading at a discount since COVID. And some people feel that H shares might actually catch up with A shares. That means just my mere catching up, Hong Kong Chinese companies listed in Hong Kong is going to appreciate much faster than A share. Just catching up alone, without even talking about the improvement in the economy. So there's one theory. I heard some people positioning their trade just to buy H share, positioning a H share just for the purpose of making money when the gap between H share and A share is narrow. But I look at this chart. This is another chart that I found is basically Hong Kong Stock Connect China Premium Index. Is actually an index published by the Hong Kong Stock Exchange. It's not an index that you can buy or ETF that can buy. There's no such. It's just simply an index showing the premium of A versus H. So what do you mean by that is that if let's say the index is more than 100, it just means that the A shares is trading more expensive than H shares. And similarly, if it's trading less than 100, it means that the A shares is cheaper than H share. That's the meaning. And the comparison is apple to apple. That means they find companies that listed both in China itself and in Hong Kong, right? And then they compare. Okay, so it's really apple to apple. Now you look at this chart since 2015, right? The premium of A versus H has been more than 100. In fact, it's been about 130, started from 130 in 2015. So something happened in this 2015. I checked the history. Is that 2015 actually is the start of the umbrella movement. The umbrella movement, remember, where there are people who were protesting and I don't know, what is it called, umbrella movement? I know they were camp at the roadside, and then they protest against certain government government displeasure. I was there in 2015 where I don't even know what was happening. So when I went there, I saw a lot of people camping at the roadside, took photos some more. Okay, so that's what happened in 2015. So Asia has been trading above the market, above the 100 since then. And later it go down, but it's still at premium. And then it goes up again in 2020. Yeah, so that was a COVID year. So right now, the premium has come down to the pre-COVID. So if you ask me whether would it go to the low point of 2019, just a year before COVID, I'm not so sure, because given that there is a geopolitical tension between US and China, protectionism against China, and all these issues, Western versus China, H shares may continue to trade at a discount. And so I personally don't think that this gap is we can safely say that this gap will close up. So when I recommend my investment to you, I did not assume that H shares will close the gap in A share. I did not use this assumption. Okay. Now another reason why there's now people feel that the Chinese market is bullish is because the fund manager right now is currently significant underweight in China. So there was a survey done, and it was found that the fund manager, right, exposure to China is really underweight, which is below this green line called pessimism. So because it's underweight, it will mean that if it's just go back to neutral, there will be a huge amount of money pouring back into the Chinese market. Okay, and this is another chart which shares similar same thing, where it's actually the actual portfolio, average portfolio weight versus the benchmark weight. So we are over here, and we find that most portfolio manager is underweight China on average. But then you look at since 2020, also the same, it's been underweight one. Okay, so I don't know, this kind of chart, I'm not so sure. So it has always been underweight. That's okay. So if you have listened to my advice and bought the ETF, then you'll find that you have about 18% in gain. So congratulations to all you guys. If you have not recommended this ETF to you, it's probably maybe two reasons. One is that there was a stock that had a higher priority. Recently, I recommended AMD over Chinese stock. So and so I recommended you that one. And then also could be the cash balance constraint, where there's not enough cash in the account. So when there's not enough cash in the account, there will be a prioritization list. Normally every month I have about 5 to 6 recommendations. Sometimes only 2, sometimes 5. And I'll go according to the prioritization list, where the top of the list will be recommended first. And so you will buy all the recommendations if there's enough cash. But normally there's not enough cash. There will be certain stocks that I will not recommend to certain people because the risk is too high and it's not appropriate for your risk appetite. But anyway, for this ETF, I did attempt to recommend to everyone of you. So I think most of you have bought it. Okay, gold miner, gold price versus gold miner stock, right? The this orange color here is the gold price, and the bottom here is the index tracking gold miners. Right. So you can look at this is that there's actually a gap initially and at the beginning of the year, and the gold miners has catch up, okay, has starting to catch up. So that means the appreciation here is quite quite good compared to the gold price itself. Okay, so if you look at 2014, earlier backtrack. Okay, I showed this chart last month or the month before. You see that wherever the gold price drop or flat, drop or flat, you find that the gold miner stock actually decreased significantly. But when there's an uptick in gold price, the gold miner stock goes up and attempt to catch up. So right now we are in this area here where gold price has gone up by a lot, and the gold miner stock is trying to catch up with it, so we can make some money through this. So what are the reason why gold miners are trying to catch up, and why is it all along it has not been doing well when gold price is flat? It's basically because a gold mining company is actually a company with operating expense. So if the gold price is flat, the profits of the company is actually very little or none at all due to the operating expense. So gold price needs to go up to a certain level before you can see a profit. But once you see a profit, the jump in profit is a lot. Okay, so I think there's a term called operating leverage or something like that. Yeah. And then another thing is that the inflation has actually starting to show signs of stability, or even might even to come down. So this is good for companies in managing their expenses. Okay, so that is why you will end up seeing this kind of chart where when times are normal for gold price, when it's flat, the stocks don't do well, do poorly in fact. And when prices go up because of the leverage, the profits start to increase significantly. And now, coupled with the fact that inflation has stabilized or hopefully come down. Okay, so that's why gold miners' stocks price is, so unusual. Now there is economics behind why gold prices are going up. So one reason could be because in Chinese market itself, a lot of people are buying gold. In fact, gold price in China is actually higher than that compared to the international benchmark. So it's trading at a premium. And another area is that the Bank of China is buying a lot of gold. Okay, they are buying. Last year they bought 225 tons just last year alone, which is the highest on record since 1977. So there's a heavy demand purchase of gold by the Chinese government. The target is about 2,500 to 3,000. That's and the question is that will it continue to go up? So on the right hand side, there's this chart showing the red color is the gold price, and then the green color is actually the federal debt of the US government. So you find there's a direct correlation of federal debt and gold price. So why is that direct? Maybe one explanation some people feel is because as the debt goes up, actually US government is printing a lot of money, and so there's so who are the main holder of US Treasury? It's actually government, right? When US issue US Treasury, what happens is that they are actually borrowing money, and so the debt gets expanded. So the people holding treasuries are the government of all the government in the world, and Chinese government is actually one of the main holders. So because of the concern that there's so much printing of money, and as the debt goes up, the credit risk get higher and higher. So an alternative is just to, instead of holding treasury, hold gold. So that's why there is a relationship between gold price. There appears to be a relationship between gold price and debt. Okay. So there's some economics. If you got my suggestion, the other day, then you'll find that you have made about 13%. Okay. Later on, I'll explain to you why out of 90 of you who have bought ETF, not everyone got 13. Some got higher and some even lower. I'll explain to you what's the reason. Okay, so you have got 13% if you have followed my recommendation. Now let's talk about Japanese market. So Japanese market right now is an all-time high since 34 years ago. After 34 years, all-time high. This chart is quite interesting. It can tell us a lot of things. So one thing you can look at this chart, 34 years, is that if you're not careful in investing and you practice buy and hold, and you select the wrong market, you could be underwater for 34 years, many decades. And of course, after you adjust for inflation, you're still losing money. But for Japanese market, the problem is that there was no inflation, there was deflation. So really, I think the purchasing value 34 years ago and compared to today is almost the same. Okay, they are quite unique. And so, I always read on the internet that you buy and hold, you sure make money. But let's see, there's always a fine print you see in all investment brochures, right? That past performance is not indicative of future. There are many reasons why, and one of them is that it's possible for an investment not to make money for many decades. And that is 34 years is actually everyone's entire working year. Okay, everyone. Or maybe it's more than the number of working years that we have. So we need to be careful. And this chart will tell us. The Japanese market, as I mentioned, is doing deep poorly for 34 years. It's because in the late 80s, there was a property bubble. The bubble, there was a property crash. The bubble burst. And so as a result, the economy slowed down and it has never recovered until recently. So when I talk about recovery, I mean that when it crashed, the economy shrunk, and we don't have inflation. They had deflation, right? The prices of goods and services continue to drop. So as a result, deflation is very dangerous for any economy because what it means that people will say that since prices it will get cheaper, why do I need to spend? It's better that I just keep the cash under the pillow and wait for, and in the future, the price will come down. It's cheaper for me to just wait and then buy later on. Wait and buy later on. So they keep their cash, they just hold cash and just wait. But you see, if you just wait, I mean, in the meantime, what are the business going to do? They are going to suffer, right? Because there's no customer. And so customer don't buy. And the scary thing is that it will just mean that the purchasing power of cash get larger and larger as long as you don't spend. So for long-term investor, it's better not to invest, right? Under deflation environment, a long-term investor optimum portfolio is not to invest because the not because the risk-free rate is high, it's because the deflation is there. So the purchasing power of cash gets stronger and stronger over time as prices of goods get cheaper and cheaper. So and you cannot do this, right? Because business need to make money, someone need to buy their goods. So Japan has been suffering deflation around for a long time. And for the stock market is doing very poorly until recently. So right now, there's a structural change in Japanese economy. Is that for the first time after so long, it finally has a normal economy again, which is inflation. So wages has starting to go up. Employers agreed to increase their wages by average of 5.3. So there's at least now inflation. In fact, in last month, I talked about, or maybe 2 months ago, I talked about a Japanese ice cream company who have apologized to their customer for increasing the price of ice cream because they have not increased their ice cream price for 20 years. Just imagine. So this is really good, really good. And there's also some structural change in the Japanese corporate governance where Japanese companies have been told they need to improve their corporate governance. So instead of holding cash, they're starting to pay dividend or dividend buybacks and so on. So there's a lot of changes involved. So that's why right now the Japanese market has been doing well. Now, if you have done unit trust, then you have some exposure to the Japanese market. 7% up since the last switch. The switch was done I think 2 or 3 months ago. Yeah, I did explain to you thoroughly the unit trust switches. Okay. Okay, this is the end of the first segment. Now I go to the now I'll talk about more on the stocks. Give me a while. Okay, so in this today's one, there are quite a lot of sections where I will be asking you to sell some of your stocks. Some stocks have been really sold because it was ultimately sold, but some have not been sold. And I wanted to hold them on a long-term basis, but I feel that money can be better deployed elsewhere when it's opportunity. So the problem with buy and hold great companies is that there can be a time where there'll be a time where the stocks are not doing well, and it may take a few years for it to do better. But in the meantime, there's a very large significant cost. Right? So some of these stocks have been holding, has been loss making, and I believe long term they will recover and do well because they have more. But in the meantime, there are other investments that are doing better, right? Like Chinese stocks has been going about 20%, and so by waiting, you're actually losing. It's double whammy. You lose money in holding an existing stock, and then you lose money because you didn't get to invest in something else that's gone up by 20% or even better. So the opportunity cost is too high to hold long term especially for stocks that has not been doing well and will need some time for changes. That's why I'm going to make some recommendation to sell certain stocks. So let's begin now on what are the stocks that were automatically sold because it hit the stop order. So ZYNEX is one of them where it was purchased in maybe October 2022. And then it's been a very volatile stocks and very volatile stocks. So recently it was automatically sold because of the stop order there, and you make 16% out of this. Moving ahead, I will try to avoid investing in such a volatile stock. But then, I never know, right? Whether it's going to be volatile in the future, because this particular stock, right, actually went down by 61% from its peak when it was first purchased, but a lot. And so remember last month I talked about the two approach to investment, and one of them is called a recovery approach. This one was a recovery approach, and fundamental was also strong, and valuation was also cheap. So that's why it was purchased. However, overall, the stocks did not go down further compared to the 61%, but it was very volatile. So anyway, it was automatically sold by the system because of the stop loss order, stop limit, sell stop limit order. Microsoft automatically sold somewhere in end of April. Yeah. So purchase 299, and then yeah, it was eventually sold recently because of the correction. So it's 31% up. Microsoft, I have intended to really hold on a long term, but nevertheless, because of the better opportunity elsewhere, this one I didn't wanted to sell, but because it hit the stop order. So that's the dilemma of having a stop order, because if you put too near to the current price, it get triggered very quickly. But if you put too far away, then it loses effectiveness. You lose all your profit. So what's the point, right? So this one, it was very volatile. In end of April, there was a very huge volatility, very, very large, right? And many of the orders were triggered because of that. Okay, anyway, the prices are really very high, and this the price is going up because of the AI hype. I don't like hypes because you don't know when it's going to end. When it ends, it's really painful. Okay. Meta, same is AI hype. So Meta was, you made 18%, and recently it was triggered again. And Meta this kind of stock is really very volatile. You look at, it was purchased in 2021 and it went all the way down and went on up. It's like really very volatile. Anyway, I didn't sell it was auto triggered. Okay, so you made about 19%. Charles Schwab. Yeah, so Charles Schwab was very unfortunate. When I first purchased in early 2023, everything was good. However, because there was 3 banks that collapsed, or 2 banks, 3 banks collapsed in early 2023, and so the entire banking sector suffered. And Charles Schwab is more bank than brokerage firm. So the share price fall all the way down. But I didn't want to sell because actually it's a good company. And never intend to sell. But recently, there was a huge decline here, very large decline. You see, this is called slip. It's not slipping. It's just really very large, and it triggered the auto trigger. No intention to sell, but it just triggered it, you know. So it's really, well, it's really, really scary. Okay, so anyway, you sold at a loss of 7%. Okay, now the stocks that was purchased. Okay, so this was, yeah, this one is historical purchase, right? So before I continue, let me explain to you the Chinese shares terminology as what I promised earlier on, because it can be very confusing. So first, H shares are Chinese stocks that's listed in Hong Kong, example Tencent. And then N shares are Chinese stocks listed in US, example Bidu. A shares are Chinese stocks listed in Shenzhen and Shanghai, but available for foreign investors through the Hong Kong Stock Connect. So this Hong Kong Stock Connect is like a virtual highway between Hong Kong and China. You just imagine it's like a virtual link. And in this virtual link, you know, the foreigners can buy the A shares, and this is called northbound stock. North, because Hong Kong is south, China is north, right? So north. So foreigners in Hong Kong can buy shares in Shenzhen and Shanghai, known as A shares, right? So northbound, so it's like virtual lane. But this virtual lane or stock connect has a quota, you know, it has a daily quota. So it's capital control. And besides, investors are buying through the stock connect will have to disclose their identity. Yeah, that's why a few months ago, I asked you to enable the stock connect in your iFAST app and your platform to give consent to the platform to provide them, provide the Hong Kong Exchange your identity. And then the southbound stock connect refers to Chinese in mainland China buying eligible shares in Hong Kong. Okay, so I don't know what's eligible shares, but anyway, A shares, the first one, northbound, also only for eligible shares known as A share, because there are shares in Chinese that's not available for foreigners to buy. And one of these is those stocks are listed under the ChiNext. ChiNext is part of the Shenzhen Stock Exchange, but shares listed in ChiNext is only available for professional investors and not available for foreigners except through an ETF, which I'll show you in a subsequent slide. And actually, I wanted to pick individual Chinese stock, and I found that many of these individual stocks are listed in ChiNext itself, which means that it's not accessible for all you guys to buy directly. So what is this ChiNext? ChiNext is something like the Nasdaq equivalent, right? You have S&P 500, Nasdaq. So ChiNext is like a Nasdaq equivalent where the more innovative new companies that are listed there. And ChiNext is only for professional investors because it's viewed as higher risk. But the thing is this, many of the companies in ChiNext are actually been listed there for a very long time. And these companies have become very mature, highly profitable, and definitely no longer a startup company. And yet they still continue to be listed there. I don't know why they're still doing that. No, not moving to the main board. In fact, these companies, some companies I saw are not even are not even a technology company. Like I found one in actually a hospital with many eye hospital in many parts of China, and highly profitable company. I don't know what is it doing there, and anyway, nobody can buy because it's under ChiNext, but an ETF can do so. Now let's look at this chart. Dating way back to 2012. So there are three colors here, right? So the bottom here, the orange color is actually the H shares, index of H shares, and then you this one above is actually a ChiNext ETF. Okay, and ChiNext ETF tracks the stocks in ChiNext, and this ETF itself is actually A shares. Right? Wow, convoluted. So you can only buy a ChiNext ETF through the northbound stock connect. And then the middle one here is MSCI China ETF, which tracks a combination of A share, H share, and N shares, right? N shares are Chinese companies listed in US. So what you can see is firstly is that the H shares has done very poorly. So it's consistent what I said earlier that H shares tend to trade at a discount compared to the other market, other Chinese market. And then the ChiNext one is very volatile. You know? So when things are doing well, it shoots up a lot. When things are not doing well, it comes down a lot. Like recently, after post-COVID, it came down by a lot. So it's very volatile. So it really looks like Nasdaq. And so it's much more volatile than those A shares. Okay. And then in the middle one is just in the middle because it's very diversified. So when you have an ETF or index that tracks a very diversified port, then initially it's less volatile. And so that's why it lies in the middle. So most of you have bought the MSCI China ETF. You have extra money, you have bought this one, provided you have enabled the Stock Connect in your ETF. And I know it's logistically troublesome because of capital control and so on. iFAST will have to do a lot of somersault just to get you to buy. Okay, I'll spare you the details later on. Okay. Yeah, so this is how it looks like. So I've got you to buy. So here was it that it was purchased in yeah, this was the two buy order for the iShares MSCI China ETF here and here. So I got you to buy end of February. So that's where, yeah, end of February. There was another purchase because it went because of the broke the resistance level. So you have made 18% profit. This 18% profit is relative to this spot here, not this here. Because if you have bought really recently, then of course your return is lower. So there's some correction recently, which rightfully there should be. And yeah, okay. So congratulations to you guys. I think I recommended in February 1st, then I talked about it in March. So a lot of you guys did not buy this because in fact you scolded me. Anyway, must follow my recommendation and make sure you have money in the iFAST account, right? Don't keep asking me to ask you to top up. Okay. I've got just too many accounts to handle. No time to ask you to top up. And I also do not know how much money you have also. So it's a bit hard. Okay. The next one is a ChiNext ETF, which I asked you to buy. This is through the Stock Connect. So yes, barely moved, very little. Slight, yeah, ChiNext hardly moved, right? So let's see. Hopefully, you will, this more risky ETF will benefit you when the market goes up again. I also asked you to buy a McDonald's. Okay, so McDonald's, we have been trading McDonald's for some time. These are the buy, sell, buy, sell. So now it has reached a support level and ask you to buy. So let's hope that it will you're going to be a profitable trade. But anyway, there was a stop loss at the bottom, so there's some safety there. Okay. AMD, yes. So I asked you to buy AMD just in May itself. So surprisingly now it has exceeded 8% return already. It's really fast. So why AMD is two reasons. One is AI hype. NVIDIA right now dominates the supply of GPUs for AI data center. Maybe I heard it's like 99%. And so it is now a total monopoly. The only chip maker that might able to compete from NVIDIA is AMD. Okay, I think AMD is 1%. Just imagine if they just become 2%, right? That is 100% revenue, right? So really, this is one of the reasons why they do not, AMD does not need to be the monopoly, does not need to be a dominant player or even a single player, just maybe from 1% become 2%, enough already. And also technical wise, yes, have a huge correction recently. And yes, actually surpassed the resistance level. Okay. Okay. This is the Alibaba. So I did recommend Alibaba, but not for everyone. They're only for those who are deemed to be suitable. And haven't been moving much. It's come down slightly, I believe. This chart was down on 22nd of May. Now it's 25th. Yeah, 3 days. I think it has come down slightly. Okay. Yeah. So just bought it recently only. So why Alibaba is one reason is because Alibaba right now has the lowest PE since IPO in 2014. So this is a PE ratio of Alibaba since its IPO in 2014. It's the lowest, But of course, it's not enough. We need to have more details. And in terms of pricing, right now it's lower than the day one of the IPO price. Now, IPO price was priced at 68, but when it trades, right, the first day it went up to $93. First day $93. So really, nobody buys the IPO price at 68 unless you bought from the primary market. And right now it's $82. After taking out inflation, it's much lower than 93. And so it has went down by a lot. If you're wondering what does Alibaba do and what are their business, then you can see that 36% comes from the retail commerce, e-commerce, and then you have the digital market 11% and cloud intelligence 10%. Okay. Alibaba has done very poorly after COVID, not just because the Chinese market has been bad. That's important reason, but because as you know, the Chinese government, in COVID period and so on, were more interested in politics and keeping their face rather than improving the economy. So Jack Ma offended the Chinese government by giving very insensitive remarks regarding regulation, and so Alibaba was punished, right? It was severely punished, and yeah, so that's the reason why it drops by a lot. There has been talk in the town that Alibaba may have to spin off because it's such a big company that it has many businesses, so it may have to spin off. So normally when a company spin off, what will happen is that if you own the share, you will get the share price of also the share price of the spin-off company. And normally that is a good thing because it unlocks the value or value of the individual companies, individual businesses. So that's another reason why the purchase. Okay, Tencent. So Tencent has a technical-wise similar story. It's been sliding down by so much, and now he has a breakout. Okay. Tencent, one reason is because it has a very strong financial statement, return capital on capital employed of 52%, gross margin of 59%, and so on. Very good as a cash cow. So if you're wondering what does it do, is that 30% of its revenue comes from games, and then 32% technology, and 16% online advertising. Okay. Bidu. So Bidu is N shares traded in US. Right now it's $100 already. Okay, it was purchased 110, so it's around $100. Now, unfortunately, my stop order was $100, just below here. So this may just auto trigger sell next Monday. I don't know, maybe I put it too low because I didn't realize. I just look at this chart, say, oh, this line here, so I put it below. But I didn't realize that if the purchase price is 110 and I put the price as a stop price 100, it means that a 10% loss will trigger, and 10% decline for any stock, right, is actually too small, right? It's just too small. Should I put at 20%? Anyway, it was done already. Yeah, I'm not so sure. Okay. Let me think about how to $100 I don't know. I'm thinking of whether should I remove the stock order. Let me think about it. So the fundamental of Baidu is such the fundamental wise is not bad. Great strong gross margin, strong operating margin, and net income and cash as a cash cow. So the revenue wise, 53% is online marketing. Online marketing, and the rest is 21% in cloud, and 25% is actually in IQ IQE. So this is a video streaming program. Sometimes I even watch it. So Baidu has the lowest PE ratio since IPO in 2005. Wow, this goes all the way to 2005. Alibaba is 2014 IPO. This one is 2005. Really a long way, right? Lowest PE ratio right now. Okay, so yeah, interesting buy. Yeah. So all these Chinese stocks I might not have recommended to you because they may deem to be not suitable for your risk profile. Okay. Yeah. So for the Chinese stocks, it's only selected, but for the Chinese ETF, generally everyone was recommended to buy. CICC. So CICC is like the Goldman Sachs equivalent. Okay, so they are investment bank, and the stock price has dropped since COVID. Since 2021, it has dropped by 57%. So we are doing a recovery play here. Okay, and reason is because in terms of share price, it's now the lowest, lower than its IPO in 2016. Share price was. Okay, PE ratio also it's not the lowest. The lowest actually in 2020. Like 6 times 5, like 5.5 times earning. Oh, okay, so but it's below average. June 2020. So June 2020 was here lah. Well, but you have bought here also, and still lose money. Okay. Okay, so there's a reason why this was purchased. So Luis asked, are we targeting more AI stock? If we do that, right, then we are just I just very afraid of FOMO lah, fear of missing out on the AI stocks. It's definitely a bubble right now. 100% is don't know when it's going to end. Maybe it will continue to go up some more. I'm not so sure. But nevertheless, existing portfolio-wise, there is still holding would be like Alphabet is still there, Amazon is still there. So the AI play is still there. Apple is still there. Apple has not really, in a big way, launched their AI roadmap. Apple is like that one, very secretive, right? And slightly behind others. But when it does something and launch something, it always takes the market by storm, right? So not so sure about Apple, but anyway, most of you are holding Apple shares as well. I'm trying to look at the peripherals of AI stock. That means companies that benefit from AI, but not AI company itself. So I've been trying to do research on electricity, power supply. So because for AI data center, there's a lot of supply chain. The supply chain need to be there. One of them is electricity. Yeah, and I'm not very entirely familiar with the electricity market, but definitely the amount of electricity needed for AI data center is humongous. Now the investing in the power supply companies is a little bit tricky because normally utility company are highly regulated. So even if there's high demand, the electricity price may not go up. If we to invest in the more downstream like oil commodity, then all these oil prices are manipulated by the oil players, right? So we can't take advantage of them. So really, I know the market is there for electricity. It just which company. Just now I saw on Bloomberg one company called Marathon. Very interesting. I thought it was an electrical utility company because it says that you'll go to places where those are like Kenya, where they generate a lot of green energy, electricity. But this electricity, sometimes there are surpluses and the demand is lower than they can supply. As a result, the electricity are wasted. So this company will go there and take all the leftover electricity. So I find it very interesting. This is, but later I'll check in detail. Alamak, Marathon is actually a Bitcoin mining company. So they are actually finding all this cheap electricity to mine their Bitcoin. So I was quite disappointed. Although profitable, but quite disappointed. So not easy to look at this. I wanted to look at companies that tracks the AI data center, right? And I did found ETF, I remember correctly, but ETF is doing very poorly. Okay, so okay, anyway, sorry for the rattling. So not so easy to find, huh? So normally not easy to find. Okay, let's go on to the stocks that we're going to cut. So I'm going to suggest that we cut loss on iFAST. Okay, iFAST shares itself. Now iFAST share is actually I know the company well, right? And their business has been growing strongly. Every quarter they report earnings, great earnings. But the share price has not been appreciating as much as its US counterpart. And so right now iFAST has a bank, and then it can do a lot of things now. And it's also well known that it has a business in managing one of the subcontractor managing the Hong Kong pensions. It's a huge project, very, very huge project. And it has actually brought in a lot of profit. So if you look at the iFAST breakdown from this is the profit breakdown from Singapore, Hong Kong, Malaysia, and China, and so on. You'll find that the Hong Kong profits, right? The quarter to the year-on-year change of the quarter actually jumps like 478% from the same quarter of the previous year. For instance, whereas and Singapore market also jumped by 82%, not bad, but Hong Kong is humongous, right? And it's not a surprise. This is not earnings that is a profit that is dropped from the sky, or we knew it all along, because the pension plan, sorry, the business for the pension has been announced by iFAST long ago, and and the amount of money they're projected to make is already well known in the market. So actually we can predict how much earnings is going to come in, and so it's actually a very lucrative business. But the market don't like it, maybe because it's SGX, but there's another reason why lah. So let me show you why is the iFAST shares not doesn't seem to exceed $7. So if you look at this, the top shareholders are iFAST shareholder. The majority comes from the CEO, Chan Chung. The second one is Cascaden. Okay, Cascaden peak investment at 12%. Okay, and it holds 35 million shares, Cascaden. So if I want you to look at this chart on what Cascaden has been doing so far. So the blue dotted line, shows is actually the number of shares that Cascaden is holding now. So, and then the white color is iFAST shares. So there is actually a pattern. Initially, it holds more than about 45 million shares, and then it drops. Okay, the number of shares it holds drops. That means it sold the shares. Okay, and when it sells the share price drops, and then it holds, nothing's happening until when it starts to go up, it sells again. Now you may see that, okay, maybe the line shows that it's coming down before it goes up, but actually you must understand this, the straight line here is actually just interpolation. You do not know exactly when it sells, but we know that in this quarter the shareholdings has really dropped. Okay, so definitely it sold when the share price went up. Okay, and then it sells again, and share price went up slightly down. So from here it seems that this Cascaden has a target price of about $7. So when, at least based on this transaction, it's like $7, and it takes the opportunity to sell when the share price appreciates. So in other words, this shareholder, the second largest shareholder in iFAST, has been trying to dispose the share price. So now the question is that who is Cascaden? Cascaden is a consortium comprising of three main shareholders: Hotel Properties, Maple Tree Investments, and CLA Real Estate Holding. Cascaden was originally formed to take over SPH, Singapore Press Holding. Okay, remember Singapore Press Holding closed down, right? And think the detail is something like is spin out into a trust that continue with the newspaper business, and then the remaining was taken over by Cascadian. So Cascadian is not running the press; it's actually running everything except Cascadian. And also remember that SPH also had some real estate. So SPH, the story is that was one of the founding shareholders of iFAST. So that's where the connection comes in, because SPH was one of the significant founding member shareholder of iFAST. So when Cascadian took over SPH when it closed down, Cascadian became the second largest shareholder in iFAST. So if you look at the website, Cascadian core business is actually real estate. Okay, if you look at the website, it invests. Actually, it has some malls, it has some REITs, and so on. So really, what it's trying to do is that it's trying to dispose the non-core business of iFAST. Okay, iFAST is not a property company; it's a fintech platform company and a bank now. But unfortunately, the amount of shares they're trying to dispose of is so large that it cannot dispose of because of the very poor liquidity, in the market. So this is iFAST daily volume. You'll find that on a good days, it's 500,000 shares exchange hand. On a bad days, it's only 143,000 that exchange hand. And this is typical of SGX listed companies, because in SGX, I believe no one is investing in SGX. All the institutions don't want to invest in SGX. The liquidity is so poor. So that's why the share price SGX, this time SGX, don't goes up. And of course, when it crashes, it doesn't go down because nobody is selling. You can't sell in the first place. So the poor Cascadian is trying to sell wherever price goes up, but as a result, it actually hammers down the price. So despite the fact that iFAST share is a good stock, and then the business in Hong Kong is getting larger and larger, and the bank in UK provides the synergy needed for wealth management, as long as this shareholder is selling, there is limited upside. So I suggest that we sell this and move on to something else. Estée Lauder. So Estée Lauder is the cut loss. Okay, wait, iFAST share price, what is the cut loss? There should be a loss of 30% iFAST, right? Okay, now let's look at Estée Lauder. Bought at about around $30 in 2022, and then it's gone down by nearly 60%. So why is Estée Lauder having issue? So in terms of business-wise, right, it never recovered from its COVID. Yeah, after COVID, it has never recovered, and the business has not took off as compared to its competitor. Okay, and in terms of the fundamentals of the margin, right, the operating margin has been very inconsistent. So on some lousy quarter, it's like 2%, or even there's a slight loss. Then on some quarter, it jumps to 13%. But in recent, the recent 12 months, the recent 4 quarters is 7%. So it's very inconsistent operating margin, and it appears to be declining as well. Okay. Now, if we look at competitor like L'Oreal, you look at the operating margin has been always consistent, 16-17%. So consistent. In fact, the recent report is 18%. So really, the issue with Estée Lauder is poor execution in business and inconsistent operating margin. So when a company has inconsistent operating margin, the market don't like. In terms of valuation, Estée Lauder is extremely expensive. So I managed to get this. This is a paid subscription, but for you guys, I just put it here, and a paid subscription where. So basically, I subscribe to this portal where it compares some of the valuation ratio with the sector median. So example, like the P ratio now here under GAAP under GAAP is 74 times, but the sector median is only 20. So it's so high, it's 256% higher than this. So it's very expensive. So it got an F grade. So something similar, the rest. So you see mostly F. So overall it's F grade. Growth-wise, also the same. It looks at the revenue growth compared to the sector media. So revenue has been declining while the media is actually improving. So it got a D grade. So overall it's C grade. So sell, right? Now let's talk about Nike. So Nike was a purchase in 2022, and yeah, it's been coming down 44% since. So why is this so? Is partly is because after 22, after we buy, right, the working capital has been declining consistently. So the blue bar here shows the working capital, and the line, orange line, is the long-term debt. So the working capital has been decreasing consistently, and this is earnings, right? So the earnings since 2020, I think it should be the COVID year. Then after COVID, the earnings has been, this is the earning, right? Has been like, I mean, has been like same or slightly lower, you know. So when there's no growth in earnings, right, after taking account inflation, it's actually actually making a loss. Okay. So in other words, the profit is coming down because we need to adjust for inflation. So so you have to sell. Nikkei valuation has same thing, F grade compared to the sector media, and then growth also below the sector media. So I suggest sell. PayPal. So PayPal is down by 64% since we bought. So what is the reason, right? So PayPal has a very colorful history that explains the reason. Okay, so PayPal, one reason, okay, in 2022, when did we buy this? 2022. Very lucky, right? After we buy, we have interesting history. In 2022, PayPal actually made an announcement, dropped a bomb saying that you'll fine users $2,500 for each offense of misinformation. So, you know, I mean, it's trying to do something about misinformation, right? About people misinformation and using PayPal as a platform to monetize their misinformation. On the surface, it seems to be a good idea to counter misinformation, but it overdo it because it said you'll fine users for each offense, 2,005. So in other words, it become a law enforcer. So a lot of people protested, and eventually it retracted our announcement, but the stock market didn't like it. Right? Then it started to ban organizations with different political views. Now, it's not in the US, a lot of people can say anything they like because of free speech and so on. So people will have different political view, and they have a lot of opinion. And so PayPal started to ban organizations that had different political views as PayPal. So it's like a very weird, like why would you want to get involved in other words, it's trying to do censorship, right? So why would, especially in US, you can't do that, right? You can't do censorship. And I mean, sidetrack, even TikTok right now is suing the US government for infringement of free speech, right? Because the US government is trying to ban TikTok in US due to the Chinese geopolitical attention, right? And trying to ban TikTok, and then TikTok now can sue the US government for curtailing, preventing free speech. So in US, you can do all these things. So anyway, PayPal started to ban organizations with different political views. So of course, the stock market hates it, right? When you're trying to do censorship. And then as a result, the CEO resigned, eventually resigned. In 2023 itself, which is last year, unfortunately, there has been a slower growth and revenue concern. There's been increasing competition and decrease in active account. So all this happened because why 2023 was such a bad year? Because in 2022, PayPal or the CEO got distracted and start to get involved in censorship, in law enforcement. In fact, in earlier years, PayPal also got involved into the LGBT controversy, so in other words, the company is like not even focusing, or rather the CEO was not even focusing on growing the business. He was trying to do everything except the business. So competitor catch up, and then people leave. Okay, so as a result, things went from bad to worse, and the valuation right now is a degrade. In most, like the example, like the P ratio is 16 times, but the sector average is only 17. So it's a very expensive company right now. Growth is also lower. Most of the time, it's lower than others lah. Yeah. Okay. So Gladys asked, why did we cut loss all this for so long? So all these companies, right, is actually meant to stay long term. Yeah, all this can stay on. So Nike itself has a moat because of branding. I believe eventually recover, and with the removal of CEO by PayPal and realignment of the business, focusing more on business, it's likely to recover. And so we want to do long-term investing rather than trading. But holding long-term has an issue lah, that because of the opportunity there's elsewhere lah. Okay, and there's more and more opportunity doing elsewhere. Yeah. Yeah. So Tesla-wise, we bought Tesla around here, and then we sold about half, I remember correctly, here at quite a large profit. But it's been declining since then for some time already. Okay. So why is Tesla stock down, and we decided to move on rather than hold long term? Is one reason because the valuation now is very high. And then partly also because Tesla has actually lost the leadership. BYD now is the largest EV car maker. And the reason why Tesla is still making money in US is because of protectionism. But BYD is can sell its EV car anywhere in the world where there's no protectionism. Okay, so that's one reason. Another reason is because there has been a sudden change of direction to Tesla. So the Tesla now is no longer this is different from the Tesla that we knew years ago. So Tesla has changed direction to focus more on robo-taxi. Okay. This is a new business because previously Tesla was focusing on making cars, right? Energy efficient EV cars. But robo-taxi is a new business. It's two things need to happen. First is that robo-taxi means that it requires the taxi to be fully self-driven, FSD, full. And a lot of people feel that FSD or full, total automation of cars is many, many years to go. And also, even the technology is there, but infrastructure may not be there. Okay, because the infrastructure may not be there to support it, and regulation needs to change. And when it comes to touch regulation, it takes a long time. Remember, the Bitcoin ETF takes, I think, 10 years to get listed. So long, right? So, so this is a new direction that actually make people a lot of people worry. And then it changed direction. It fired an entire supercharger team, and it's kind of like that one. It's just fire like this, and then 2 weeks later, you rehire some workers back. So in other words, the firing was done was done in haste without thinking. So I suggest Elon Musk is to be the Tesla is to be sold, primarily because the direction of the company has changed. It's now like becoming like more Uber. Like Uber also tried to do FSD, but I don't think they did very well. So but anyway, it's trying to become the next Uber, and then Elon Musk is very, very erratic. Like they can hire and fire staff without a blink of an eye. Okay, so think there are better opportunities elsewhere. But some of you may ask like how to play the EV market. How do you do it? Yeah, I'm waiting for the lithium market to recover. I asked one of my staff to do some research on the lithium market, which is the raw ingredient needed to make batteries for cars. And the demand for batteries is primarily from EV. And the lithium right now is at all-time low because there is a huge inventory surplus. So when lithium starts to recover, when inventory drops, I think it's time we can buy some lithium stocks. Okay, why not now? Okay, Brown-Forman, which is the liquor company, is down by about 18%. So why is this so? It's primarily because valuation is too expensive. And so I don't think we need to let go to release some capital to buy other stuff. Yeah, okay. Yeah, again, is to release the capital. Cannot wait already. Okay. Long term is okay. Actually, the long term not bad. The growth, is actually A grade. Is actually much better than its competitor. This has a huge growth. Maybe that's why, because the growth is so high that the value is too very expensive. It's like that when a company has high growth, the share price tend to be valuation wise tend to be very expensive. But we need to unlock some of the money to buy other stocks. Okay. Walt Disney also to cut loss. So why is it the Walt Disney cut loss? Is really the valuation is too expensive right now. So we cannot wait for I believe if we wait for another 3-5 years, it will recover and do well, but no, cannot wait already. Okay. I think I have started to sell last month. I can't remember. Yeah. Then yeah. Walt Disney has more just that the recent Marvel shows are horrendous. Even the small kids also don't like. But anyway, we need to release the stock market. So here is the summary. Okay. Now, some of you have asked me whether is timing important. Okay. Whether I mean, what I mean by it's like when I give a recommendation, is it that you have to reply to me ASAP within, if you delay for a few days, does it really matter? So so I just randomly just pick one recent recommendation, not too long ago, which is the silver and metal ETF, right? Then I did there are 90 of you guys, 90 who bought it, and then I did a distribution histogram on the returns. I was quite surprised to find that actually only half was in this region, 16 to 17%. The remaining, okay, then the next about 14 people was in 15 to 16, so not bad lah. But then there are so many that has returned, they are so poor. So I was wondering why, So I found okay, there are two main reasons. So one is the same issue again, like you don't have enough cash, and there was a few stocks, and I prioritized something else above this. So the other one, the first one got recommended, and this one was not purchased at the point in time, and then eventually it was purchased the following month. So that means there was because of that, the purchase of this ETF was done 1 month later. Okay, when you have enough cash, or when there's no other stock that's has a higher priority than this. So there was a delay. And also another reason because I did recommend to you, but there was a delay in replying to me. So some actually of you were traveling, and so you only replied to me or actually took the calls 1 or 2 weeks later. So in other words, I think from this we can conclude that timing is important on this. It does matter. And also you must understand that before I make a recommendation, I would have delayed on my end for some time because I need to think about it. I need to do some research. I myself need to feel to have the conviction, and so I don't act on the very first stock that I find interesting. I will think about it and so on. Unfortunately, sometimes I think so long until the stock went up already. Usually I have one long list, but sometimes I think so long until it went up. Then I never recommend to you already. So in other words, when I made the recommendation, it was already so-called delayed for a while before I can have the conviction to suggest to you. So if there are other delays, whether Is it because there was not enough cash, or because the reply to me was a bit late? Yeah, that is very unfortunate that does affect return. Of course, it's possible to make money out of that, because um, I mean, if the stock price falls, then it's beneficial, right, to buy at a lower price later on. But I think that the statistically speaking, the chances of that happening is lower, because when I have made a very high conviction recommendation, maybe there's 2/3 chance that it's going to go up. Okay, because that's why I have high conviction, right? It's 50-50, there's no conviction. So maybe there's 2/3 chance. So 2/3 of the time, the price is going to go up over time. Yeah. So to the person who asked me, does timing really important? Do you really need to reply to me and pick up the call ASAP, or can delay for 1 or 2 weeks? Then the answer is, I think it's best that you reply as soon as possible. Don't delay. Don't think about it, because I already think so long already. You think some more, it's going to delay further. Okay, you cannot imagine. Right now, the last I checked, I managing $52 million of investment. So the amount of money I'm managing is getting a lot, especially this year's the bull run, right? It's been quite good. So I jumped from 40 million to 50 million in just a few months. Not because of new money coming, but because of the return. So I do think a lot before I recommend. So don't delay. If you have issue trying to get back to me because you're overseas, then iFAST can call you using WhatsApp. I said it has to be done during Singapore timing. Okay, 9:30 to 5:30 Singapore time, and they can call you through WhatsApp to take the call. Okay. Another question that was asked to me about this reaction of stock market is a commonly asked question that's asked many times. So now I'm going to explain a little bit more. Yeah, about reaction of the stock market. So when market move, right, it move for a certain reason. But contrary to popular belief, actually it doesn't move with the current news. It's always based on expectation and whether the expectation is met for the better or for worse. So in terms of macroeconomics, the expectation is expectation of inflation, whether it's going to move higher or lower. So I don't know how to say it. Let's say the market expect inflation to be 5%, but it turned out to be 5%. The market is not going to move. Although 5% is horrible, it's horrendous, right? 5% inflation is very high. So, but it's the expectation, whether you meet the expectation. If it's 5% and it turned out to be 5%, okay. But let's say the interest rate expectation is 1%, but it turned out to be 1.5%, the market is going to crash. Although 1.5 is very low, no, but it's not the absolute value. It is the expectation. Okay, it's the same as interest rate, whether is it high or low, right? The actual value itself is not important. It is whether is it higher or lower than the expectation. So that means it's actually a second order thinking. Okay, for you guys who are in mathematics, first order is just the variable. Second order is the differential. Right? So that's the analogy I can give you as a former engineer. So it's not the actual value, is whether it exceeds or disappoint relative to the expectation. And it has nothing to do with the current, and it may not do with the current situation. Let's say the government announced GDP contracted, but really the GDP publication, right, is actually historical. It's actually old data. It's not about, it's old. So the market is not going to be interested in old data. In terms of microeconomics, in the same stocks, it's about the expectation of earnings growth, expectation of subscriber, if it's a subscriber-based company like Netflix, for example, or PayPal. So if let's say the market expect earnings this quarter to be $1 per share, and the actual announce was 110, then the stock is going to go up immediately because it exceeded expectation, and vice versa, right? And then also for stock, also the expectation of earnings growth. So earnings growth is the second order already. Okay, expectation is first order, earnings growth is the second order. So what I mean by that is the earnings also need to grow, right? But there is an expectation of how much is growing. Okay, so if the let's say if the company announce, okay, for this quarter we exceeded earnings, and then the CEO say that, however, the earnings end of year is going to be like that, and that is below the analyst expectation, then the stock is going to drop. Normally, the second one, right, has a greater influence than the first one. That means the expectation of the earnings growth. Earnings growth is time bound. It's a future. It looks to the future. Okay, so if the earnings growth for next 1 year, the CEO say is going to be below everyone's expectation, the stock is going to drop, even though it has exceeded the earnings for the current quarter. There's a lot of expectation. Okay. And of course, same as subscriber, right? Whether is it below or above subscriber, and also actually subscriber growth also important. Okay. So questions, the feedback that many people ask me is not to do with expectation. And example, like most of my time, my clients say that, are we in recession? That is not important, because there's nothing to do with expectation, right? And even we are in recession, it's actually old information. Right? It's more like, when will the inflation happen? When? Is it December? Is it January? When? And then contract by how much? Okay, so that is expectation. So if the expectation changes, the market will react accordingly. That's why there's so much hype on interest rate, right? How many rate cuts are going to be this year? So there's an expectation. They say it was a 6 times, 3 times, now 1 time. So the expectation matters a lot. So not so easy, stock market. Sometimes very confusing. Okay, any questions so far before we end for the day? Okay. Okay, so I think that's all for now. And yeah, so if you have no questions, then we end for the data. Today no photos. Okay, didn't go tour last month. So had a good afternoon later on, and yeah, any questions you can just let me know. Okay, so bye everybody. Bye.